Well then, it looks like we're live. Hello everyone that's with us so far. You might not think it, but sometimes on this side of the screen, it's like the inside of a cockpit in an airplane. You see me and we look through things on the screen, but I've got like 10 tabs open and I'm trying to manage to see who's saying g'day in the comments and also have all the tabs and everything that I want to talk about ready to go. So we've got a lot to talk about today. It's always my pleasure to have you with me, and thanks for taking some time out on your Monday. It's always a bit of fun. We'll find out what the ASX is doing today. Carlos says, loving Mondays at 12. Well, Carlos, it's my absolute pleasure and our absolute pleasure to have you with us today. If you are new to the SelfWealth live streams, which we go live every Monday at 12 noon during the trading day, you can just jump into YouTube there, say g'day in the comments, and post anything that you're thinking about. If you've got some companies or something that's on your mind, you can jump in there and say hello. So, as always, my name's Owen Rask, and I'm delighted to be hosting this 60 minutes live stream with you, where we're going to talk about some companies, we're going to talk about franking credits, and I just love getting out here and chatting with investors like yourselves. On behalf of SelfWealth, the team at SelfWealth are just trying to help people invest better, and so this is a great opportunity and a great way for all of us just to become better as a group. I've got Rob with me in the chat, so if you see any comments from either of us, it could be either of us in the chat. So yeah, Rob can help you sort things out and point you in the right direction of any kind of, I guess, support questions. But if you do want anything to do with your account, like let's say you can't access your account, or you're wondering when's this new thing going to come out, or can you do this and can you do that, the best place to go is selfwealth.com.au. Hit on the live support tab there, and one of the great team will help you out. I'm here to answer your investing questions, and what that means is there's a special set of rules here in Australia, one of them being that I can't give you personal financial advice. So if I answer any of your questions, or we talk about portfolio stuff, which we're going to talk about today, we're going to talk about dividend income and some companies, it's all limited to general financial information only. So great to see everyone's already saying g'day. And Rob's given us a nudge. Yeah, he said, don't forget to subscribe, because Carlos said, don't forget to hit like. Yeah, and that's the thing. If I notice actually when we're dialing in today, if you want to, hit subscribe. And the benefit of hitting subscribe to the SelfWealth YouTube page is that you get notified if you've got like the YouTube app on your phone, for example, when the channel goes live. So then you don't have to wait in your email every week for the notification. You can actually see if something's going live on your favorite YouTube channel. So Chanda's back with us. Jonesy's back with us. If we pay you, you can advise us. Well, maybe next week, Jonesy. So that's all good. Okay, so yeah, as I said, my name's Owen Rask. We're going to talk about some investing today. If you want to learn more about any of what I do, you can head to rask.com.au. You'll also find our financial services guide there, which is really important for risk and all of that sort of stuff. So today we're going to be talking about franking credits, and in particular, I'm going to loop back through what we talked about last week, which was passive income from the stock market. So I'm just going to jump over here real quick. Back on the SelfWealth YouTube page, and you can see, you can hit subscribe just here if you like. Back on the SelfWealth YouTube page, you can see that this is the passive income session we did last week. It was quite popular. We had a lot of great comments coming through. I was wearing a different shirt last week. I try and mix it up, but my wardrobe isn't that extensive, if I'm honest. So last week we talked about basically how do you kind of build a portfolio from the ground up and try and earn a passive income, because we know that that's a really popular thing for people to do. They hit the share market and they're like, okay, there's two things that I want. There's growth and then there's income. So today we're going to focus more on the income side. G'day, Gilly Monster. Always a pleasure to have you with us. Same with you, Charles. Gilly, I feel like you've been with us since day one, which is awesome. So great to have you back. Okay, so franking credits. Let's have a quick discussion of what franking credits are. So there is some wonderful tax information on the ATO website, which we'll just get to in a minute. But basically, the way you can think about franking credits, and I did a video years ago on this, which I'll just show you quickly here, is basically you have a company which you own shares in, you have the ATO which collects your tax dollars, and then you have you, the investor. In other parts of the world, the company pays tax before it pays you a dividend, and then you pay tax to the ATO. So the ATO gets paid twice. So if this was the United States, let's say this was Apple here, a company I own shares in, it pays tax, like company tax, then it pays me a dividend because I'm a shareholder, then I pay tax to the IRS in the US. But in Australia, what happens is if, for example, the company, let's say it pays a dividend, and in this case, it's made $100 of profit and it's paid 30% tax because that's the company tax rate, and it pays out all of that profit to me as a dividend over here. I would normally pay tax at my income tax rate, but because of the franking credit system, I can already claim that the company's paid tax on my behalf. So let's just summarize. The franking credits are just tax credits that are stored at the ATO. Me as a shareholder, I can claim back those tax credits at tax time because it prevents double taxation. The company's already paid tax, so why should I? And that's the basis of franking credits. Now, there was a lot of debate about this. G'day, Vishal. Good to have you with us. There was a bit of debate about this at the last election. And basically, the counterpoint against bringing in legislation to change franking credits was that if you have an investment property, like let's say this is an investment property here, and it pays you rent, which is very similar to a dividend, the rent isn't taxed here. The rent is only taxed when you receive it as the owner of the investment property. Likewise, if you have a term deposit at a bank over here and it pays you a $70 amount of interest, you don't pay tax at the bank, you pay tax when you receive the interest. So why should you pay tax on a dividend, right? So Vico says individual tax rate is up to 45%. So I may end up paying tax on the dividend. That's correct. So in this example here, Vico, and for everyone, what we have is a company paying tax at 30%. And then that means that it's $30 is stored at the ATO. Now, if my tax rate was above the company tax rate, I would still pay tax. For example, in Vico's example here, he says 45%. Well, if you pay 45%, let me just bring this up. If you pay tax at 45% on your dividend and the company's already paid 30, that means there's still this gap here that you need to make up. And if your tax rate is below 30%, let's say you have a 20% tax rate for round figures, that means that there's 10% here that you can claim back from the ATO. And that's why it's called an offset. So it's called an offset. And franking credits are fantastic, obviously, for basically everyone in Australia. But there are some rules. I want to be clear. There are rules. People just think, oh, I trade stocks, therefore I get franking credits. Not necessarily. So let's jump back in and have a look at what some of the rules are. So if we jump over to the ATO website, we can see there are some rules for when you cannot claim a franking credit offset. And they're basically, like you can go in here, and I'll put the link in the show notes here. So ATO guide. And what you can see here is there is a holding period rule. And then there's something called a related payments rule, which is a bit more complicated. And then there's something called a dividend washing integrity rule. Now, I'm going to give you the very simplified version of this. I would encourage you to read it if you think that you might fall into some of those other categories. But by far, the biggest one is that you basically have to own the shares for at least 45 days. Now, notice here how it says at risk. So Triton asks, how do you know if the dividends are franked and how much percentage is franked? We're about to get to that, Triton, so great question indeed. So here we can see that we've got to hold the shares for at least 45 days. Now, this is really important, guys, because if you are the type of investor that typically owns shares for, say, 30 days, then you may not be eligible to claim back the franking credit. So some people try and wash their dividends, or they try and buy into companies just before the dividend date and think, oh, well, it's got franking credits too with this latest dividend. Yes, but you may not be eligible to claim them because you don't hold them for 45 days. So keep that in mind. Now there is like a rule within that rule, classic, legalistic behavior. Dividend strippers, Harris calls them. Yes, dividend strippers. There we go. That's kind of the that's another way to put it. We'll say that much. So here we go. There is a small shareholder exemption. So if the holding payments rule, the holding periods rule, sorry, does not apply if you have a franking credit entitlement that's below $5,000 a year. So this is really interesting, right? Because you can see here that by the time you adjust for franking credits, it actually can be quite a bit of money that you can earn from your portfolio before these rules will apply. But to be honest, most people that have bigger portfolios anyway aren't churning and burning their portfolios. They're not constantly turning it over because that triggers capital gains tax as well, right? So most people that are pursuing this kind of income from the share market strategy, they're not typically holding it for less than 45 days anyway. A special note here is for preference shares, which is 90 days, or for certain preference shares. If we come down, we can see an example of the related payments rule, but I'll just read it out to you here. In certain circumstances, the related payments rule prevents you from claiming the franking credits attached to franked dividends if a related payment is made. So I guess this is just another thing for you to look into. If you think that you might fall into this category, not many people do from my understanding, this rule applies if you make a related payment. For instance, you or an associate are under an obligation to pass on the benefit of franked dividend to someone else. So I'd encourage you to go and check this out if this is relevant to you. But pay very careful attention because obviously franking credits are a meaningful thing. And finally, we have the dividend washing integrity rule. This rule prevents you from claiming more than one set of franking credits where you have received a dividend as a result of dividend washing. Dividend washing occurs where you or an entity connected to you sell an interest in shares that you hold while retaining the right to a dividend. And then by using a special ASX trading market, you purchase some substantially identical shares. So, I mean, there are many schemes and different ways and different thought processes that people go through to try and get more dividends from just what would be a regular dividend. But for us mere mortals that are just looking for dividends in the form of a 6-monthly or even a quarterly dividend from whatever investment we're making, the key one here is the holding period rule. And this also applies to other types of investments, not just shares. So it can be, ASX shares, but it might be ETFs as well. So you've got to be careful about how long you're holding the investment. So not everyone can claim franking credits. So there's also some eligibility criteria. So I'll just get this up. Eligibility criteria for franking credits. And we're about to get to the good stuff in just a moment, guys. So we're going to get to the stuff, like which companies offer franking credits, and I'm going to show you how to do that in just a minute. But there are some general rules that you have to consider, which I encourage you to just speak to your tax agents to ensure that you are eligible. But the big one is that holding payments rule. Do you have any plan to start ASX trading games for newbies? That's a good question, Vinay, that might go through to support. Or Rob might know the answer to that and be able to respond to you in the chat. Okay, so we know we've got to hold the shares for a while. We know that there are certain rules in place that might govern some weird, tax treatments. We know that that if your tax rate is above the standard 30% tax rate for companies, you might pay a little bit of tax, but you can still get the majority as a tax credit or franking credit. We know that if you earn if your tax rate is below 30%, you might be eligible for a refund on your tax return if everything else falls into place. So how do you do it? The easiest way to get a franking credit refund is to make sure that you keep track of your portfolio and any companies that pay fully franked dividends. Make sure your broker, i.e. SelfWealth, and your share registry are all up to date. So it's got the correct address, it's got your tax file number at the share registry. There's a wonderful document actually written on the website from SelfWealth by Jared Purchase for share registry. So this explains, for those of you that don't know, there's a company, and I'm not going to go too far into this today, but there is a company called a share registry, and this company works on behalf of the company that you own shares in, and they effectively make sure that your shareholding statements and your dividend payments and everything are up to date. Some people forget to do this. What this means is, if you don't put your tax file number with your share registry and you don't update your bank details, you might find that you get a check in the mail, or that can become lost money. So you want to make sure that all of your information is up to date with the share registry and with your broker so it matches. Okay, so we've been through all of that. What is the net impact of franking credits? Let's just say we have a franking credit of a dividend per share of 50 cents. So it's just popping this in here. Let's say you own 10 shares and the franking credit percentage is 100%. What 100% means is that the dividend is fully franked. And so that means that it's franked at the maximum company tax rate, and that is passed back to you. So here we go. We can see the franking credits per share are 0.214. Total franking credits are $2.14 across all 10 shares. So you can see here that if we have a 50-cent dividend, we're getting 0.214 in franking credits with that, assuming it's fully franked. So what you can actually see, that's a pretty big impact. So this dividend here is what we call fully franked, because we know it's fully franked. And this one here, if we were to add the franking credits, I'm sorry, here's my hand, the franking credits plus the dividend in cash, that's called a gross yield. So that's adding the two together. And so there are some formula to figure this out, but it's really important that you know which shares are fully franked and which shares aren't. And now there was a great question in here before from Triton that basically asks, is it possible to determine which shares are fully franked? And yes, typically the company will make an announcement. So let's go into SelfWealth. Let's have a look at Commonwealth Bank of Australia, which is a very popular dividend stock for obvious reasons. Let's go into news and announcements. Let's bring this down and let's look at price sensitive only. And what I want to look at is the 2021 annual report. And why don't we just download this while we're here? I always do this, but it's just because I've got a small screen. Sorry, guys. So if we come into the Commonwealth Bank annual report, we're coming through, and we can see everything we need to see here. Obviously, when a company pays fully franked dividends and they pay a good dividend, they're going to make it very obvious that they've paid a dividend and it's fully franked, right? Because they want you to know how good it is, that the dividend is so great that they've paid you and all this sort of stuff. So here we can see on the right-hand side, Commonwealth Bank of Australia has said we've paid $3.50 in dividends per share, fully franked. So you can see here it says fully franked. Another way to check it is just to press Command F, or I think it's Control F if you're on a Windows, and just search for fully franked. And you can see it's mentioned here once. It's actually mentioned 24 times in the annual report. So if we keep going down, we can see fully franked, fully franked, fully franked, and you can see it just goes on and on and on. Now, this tells you which companies have paid a dividend that's fully franked. There are some other announcements that you can get in here that will basically show you what's fully franked, when the dividend is going to be paid, and that's effectively this one right here. So sometimes, or sometimes all the time, a company will do a notification of dividends to the ASX. So meaning that they'll put out an announcement after the annual results to tell you exactly how much the dividend is, when it will be paid, what is the franking credit percentage, and so on. And you can see this here. This is everything you need to know. And I took this just straight from a CBA announcement, so from a Commonwealth Bank of Australia announcement. So Gilliam also says, if it is an SMSF, dividends are either 15% taxed or 0% taxed if in pension mode. So it's a bonanza. Needs to change, but at the moment, franking credits are also cash refunded. Double bonanza for super. Absolutely, Gilly Monster. And you can see why Australia's dividend army is very passionate about franking credits. So, for example, SMSFs, self-managed super funds, but all super funds benefit from having franking credits in place because self-managed super funds pay tax at a reduced rate. So it's much easier for people that have self-managed super funds, or even myself that's in an industry super fund, to have that I guess benefit of franking credits. So there's a lot of people winning. There are a lot of people winning with the current franking credit rules, which is also called an imputation system. So yeah, I'm all with you, Gilly Monster. What do they say? Make hay while the sun shines. And another thing is that it's important to remember when we look at things like, let's go back to the homepage here on SelfWealth. So if we look at, say, a market chart like this, right? So this is interesting. Keep this in mind. When we look at a market chart like this is just a very basic example, but let's say maybe if we get like, what would be a good one? STW. So say this is an ETF that tracks the ASX 200. And you can see over a very long period of time what that looks like. It looks pretty good, right? But keep in mind, many of the indices that we look at, like the ASX 200 and the All Ordinaries, they don't include the benefits of dividends. So if you look at an indice like the ASX 200 total return, you will see that the return is actually substantially greater than what you get without dividends. And so this is very unique because Australian companies love to pay dividends. And why do they love to pay dividends? Because of franking credits. And here's another thing. So I'm saying to you, this is just the price return over time. Then you've got the dividend on top. Some indices will add dividends in so you can track them. But then the third thing is there are some indices which also add the benefit of franking credits to that. So if you add on dividends plus franking credits on top of the stock market's performance, you can see why the Australian stock market is one of the best performing, why it is called the lucky country. So we've got some comments in here. Zemasu says, how is it that companies store / retain franking credits for future periods? Yeah, so you can see if we go into a company's report here, and by the way, Commonwealth Bank is not the company that we'll be talking about today. We've got some more interesting companies. So I think we can just type this in. I'll see what happens. So what I'm actually searching for here is Australian franking credits. The franking credits available to the group as at 30 June 2021, after allowing for Australian tax payable in respect of the current and prior reporting period's profit, are estimated at $3.7 billion. So here we are, CBA is saying we've got a heap of franking credits that are available. I think we'll actually find out. Where is the next thing? I'm actually going to show you another company in just a second. But basically, you can come in here and you can search and you can see how much franking credits the company has in the bank effectively. I'll go, if you can see me on the video, in the bank. They're not actually in the bank. They're stored with the ATO to pay out in future periods. So much so that some companies can have massive franking credit balances ready to be paid out in the future. Some of them also haven't got enough money today to pay franking credits. So what they do is, but yet they have franking credits. So let me just clear this up. So they can have a franking credits balance, but not enough cash to pay a fully franked dividend because they have to pay a dividend to release it. So what they do is they sell part of their business to release the franking credits so they get some cash in the bank and then they can sell it out again. Oh, Plant One's back again. Wonderful. So here we go. So Modern Da Vinci says SMSFs are useful if you have at least 500,000 floating around. Yeah, so Plant One says million, and that's the thing, right? So SMSFs aren't for everyone. To basically not to. There are, if you see a financial advisor, the current Productivity Commission looked into this and basically said you have to have at least $500,000 to have an SMSF recommended to you by an advisor. But then financial advisors kind of pushed back on that and said, well, or the Productivity Commission said $1 million. Then financial advisors said 500,000 and so on and so forth. But remember, it's not just people with an SMSF. Even myself, I'm in a retail super fund, just a normal big one. my super balance also goes up because of franking credits. So keep that in mind too. Claire says, so glad to have this chat on franking credits. Will be something I'll refer back to for sure. It's something that certainly confused me for a long time. Loving this chat. Thanks, Claire. Me and Rob really appreciate that. She asked, by the way, does anyone know who Frank is? Yes, that's a great question. Who is Frank? He's giving us all of these credits. Maybe Frank's in the chat and can help us out. We will see. So anyway, back to franking credits and back into SelfWealth. So you can get franking credits from individual shares, but you can also get them from ETFs if you own ETFs in your SelfWealth account. So if we go back to our stock watch list that we've been tracking in the SelfWealth lives. So, we can see, do we have any in here actually? It doesn't look like we have any. So say, for example, this is a good point. A lot of beginners don't understand this. Only Australian tax-paying companies can generate franking credits. So, for example, Apple up here doesn't pay franking credits. Intuit, which is the US accounting company, doesn't pay franking credits. PayPal, which is a company I own, doesn't pay franking credits. Washington H. Soul Pattinson is an Australian company, so it pays franking credits. But there are other examples, like say Wisetech here. If we click on Wisetech, we might be able to come down and see. Let's have a look. Let's jump into Wisetech's announcements. So we go price sensitive. I always just go back to the annual report, guys, because I find it's the most robust way to see if there's a franking credits balance. So let's see if, here we go. So here we go. We can see the franking credit balance of Wisetech, which is 36 million. We've got to remember that there are companies that are Australian. So when we look at them here inside SelfWealth, we see the Aussie flag. There are some companies like Wisetech that do a lot of their business overseas. So that means when they're earning profit overseas, they might not be paying tax here in Australia for that profit, which means that they may not have the full effect of franking credits. So that means when you get paid your dividend, it might not be fully franked, it might be partially franked, in which case they're not passing back the maximum amount of franking credits that they can. So let's have a look. The directors have declared a fully franked dividend of 3.85 cents. So this is interesting. So even though Wisetech earns a lot of its money from overseas geographies, it actually can pay a fully franked dividend. So let's have a look here. So here we go. This is down the accounts. So this is in the annual report for Wisetech. And you can see here that even though they do a lot of their business in the Americas, so like the USA, and Asia Pacific, that probably includes Australia, and Europe, Middle East, and Africa, even though they do a lot of their business overseas, they can still pay some franking credits. And okay, so here we go. We've got some other questions. In my tax return, the franking credits were added to income, then later deducted from total income. Can't see how this makes any difference, to be honest. Yeah, so Paul, for an individual. So this is, so obviously I can't comment on your personal tax situation because I don't know it, nor am I a licensed tax agent to give advice like this. But what I would say is that, remember, the dividend, as it's paid to you, that's a form of income, right? But the ATO stores the franking credits on your behalf from the company. So you have to effectively, put all of the dividends into your tax return, and then, assuming that your tax file number is correctly uploaded, you've got your franking credits, correctly put into your tax return. Then it's deducted. So it comes back to that point that if you receive a $10 dividend, you'd rather it be fully franked than not fully franked, because at least it lowers the amount. Even if you don't get a tax return, it lowers the amount that's actually going to be paid from you to the ATO when you do work it all out in the wash. Just a reminder, guys, that any of the questions that I answer are limited to general advice because I don't know everyone's situation, so I can't give one-on-one advice. It's just generally speaking about ETFs. Okay, so let's have a look at 3 companies. Now, I've got 3 companies already lined up to talk to today. So just be mindful that I'm going to talk about these companies I've said for 2021 and beyond, these are companies that I think are really interesting companies because they actually are not just your regular dividend income stocks. They're not just, your banks and all that sort of stuff. There's Teresa, for the SelfWealth, I just noticed you put a comment in here about share registries. There is this little help doc. There you go. There's a little help doc from the website there if you're interested. I also did a podcast on this not too long ago for the Australian Finance podcast, one of the podcast series that I host on how to use a share registry. So we're going to talk about the three companies. The first company is NetWealth. So if you're familiar with NetWealth and you want to chuck your comment in, tell me what you know about it. Tell me if you like it or you don't like it. Now, keep in mind that all of the stuff that we've talked about in recent weeks, so, we've talked about passive income, we've talked about how to, value tech shares, we've talked about how to analyze companies from like a risk perspective. I want you to remember that if we talk about dividend income today, the dividend income, what you get over here is only the result of everything that's happened before it. So everything that's happened in time that led up to that point is what enables you to get a dividend. Dividends don't just pop out of thin air. They don't just it's not like a money printing machine. These are businesses that you're investing into. So the first point of call is always, is the business strong enough and financially capable of paying a dividend? And we're going to talk about how you can look at that today. So let's jump back in. So James said, found them a bit expensive. And here's a new question. So James, are you talking about NetWealth as in being expensive? That's NetWealth? Let me know, because that's really interesting bits of feedback. I am new to SelfWealth, says Pandrisi. Would I be able to get an annual report with details of dividends received? That's a good question for Rob. Rob might know the pipeline for everything that's coming up. So I own this company. This company is called NetWealth. And so NetWealth isn't exactly, we're here talking on behalf of SelfWealth, right? Like everyone here uses SelfWealth. SelfWealth, the company that we're all here talking about, the platform that you see on front of your screen, is different to NetWealth. NetWealth, which is this company right here, predominantly deals with financial advisors, and they help financial advisors manage portfolios and manage the wealth of their clients. So, for example, if I was to go and see a financial advisor and they said, hey, Owen, you need to start managing your super in this way and that way. And by the way, you've got all of this cash there. We want to invest that in this managed fund on your behalf. An advisor would use NetWealth. So that's a really interesting business model, right? Because effectively they're taking the client's money, investing it for them, and then the advisor, it makes the advisor's life easier, but it also means that a company like NetWealth can earn regular fees from clients and from financial advisors using the platform. Modern Da Vinci says, comes out of retained earnings or current or last financial year profits, depending on the dividend, if it is an interim or final. Yep. Dark Dragon says, okay, I'm a super newbie and this franking credit lingo still confuses me. So is it good to manage your own super even if your super is measly given where you are in life? And Dark Dragon, this is where you'd want to see a financial advisor. But in short, you don't have to. It doesn't matter. There's no difference. So let's say, for example, you're with Australia's biggest super fund, which is Australian Super. If you're with Australian Super, your super still benefits from franking credits because Australian Super is just investing your money for you. Doesn't matter if you have that or a tiny little self-managed super. There's a heap of different literature on self-managed super funds, and you kind of just got to determine what's best for you. And the way you do that is by speaking to an advisor or kind of understanding that for yourself. So James says, I think, James, you're referring to NetWealth when you say that it's actually an expensive platform. Yeah. So if you go to NetWealth and you want to be an investor in NetWealth, it's actually quite expensive. And you'll find that it's a lot more expensive than SelfWealth, for example, if you're an individual investor. But that's because it doesn't cater necessarily to individuals like you and I. It typically caters to people who are financial professionals or deal on behalf of other people. So let's say, for example, if I'm a financial advisor and I have 30 clients, I might use NetWealth to manage all 30 clients in one go rather than having different logins or something like that. There are plenty of others, but this is just one of the companies, and I'm just explaining it here to explain the business model. So NetWealth here, you can see that it's in 2021, it had total income of $144.9 million. It had operating net cash flow, that's before tax, of 77.9. I'll zoom in a bit here. You can see it made 22.1 cents of earnings per share, and the dividend was 15.8 cents per share. That's what CPS is, cents per share. So the first thing that I want to talk to you guys about is basically, let's make sure the company is making a profit. And so when we go into the annual report, we'll bring this up right here. We obviously need to understand how the business model works, right? We can't just assume that it's going to grow and we're just going to get wonderful dividends for every year into the future. That's happened for bank shareholders, but in reality, that doesn't happen with every company. So as you guys know, when we've talked about the 5 rules that I follow for investing, one of those is growth. I want to make sure the business is growing. So here you can see NetWealth, and I might actually just download this again. So apologies that I didn't have this prepared in advance. But we can see here, NetWealth, right here, revenue was up 17% in FY21, and we can see profit was up 24%. Now, this is really interesting because it means, and it shows us that the company seems to be growing, at least 1 year over year, it seems to be growing. We'll jump back into SelfWealth in a minute and we'll show you some other stuff. And you can see on the second page, the second meaningful page, we've got the dividend information. And we can see here that the interim dividend was 9.06 cents, and the final dividend, which was expected to be paid after this report was issued, was 9.5 cents. And we can see the franked amount was here, and the tax rate was 30%, so it was 100% franked. That's what we want to see. Yeah, so James says NetWealth gives you flexibility for investing in personal super. Yeah. So here we go. So in total, NetWealth paid 9.06 plus 9.05 cents, so around about 18.5 cents in fully franked dividends for FY21. So that's where, if we come back into SelfWealth and we come back onto the homepage here, we can see the dividends per share is written right here. And I'll zoom in again just so it makes it a bit easier for you. We can see here that the dividends per share were 19 cents. And that's basically what it's telling you, 19 cents of dividends. Now, we obviously checked before to see that it was fully franked. You can see the last dividend is right here. You can see the ex-dividend date is the 26th of August, and it was paid on the 24th. So you had to own shares on the 26th to receive the dividend on the 24th, about a month later. Now, if we look and see, the first thing that I want to show you guys is basically comparing profit to dividends. So we can see right here that if you took the profit that NetWealth earns, I'm just going to bring this up. Okay, I'll zoom out a bit again here. So this is the income statement. You will remember from a few episodes ago, we talked about the income statement and we talked about the balance sheet. So the first thing here that I've got in my notes is we want to make sure the company is growing, which we did. We saw that revenue was growing year over year. But we also want to come right down the bottom here and we want to see profit for the period. This one right here, we want to see that profit is increasing. And again, it's increasing, which is good. Because when you break the profit down per share, so let's say the whole company made $54 million of profit, this right here, then we divide it by the number of shares, that would give you 22.5 cents of profit per share. I always use diluted when I'm looking at earnings per share. Just so you know, for those that there have been a few people here today that said they are newbies, that's totally cool. You're in the right place. So earnings per share is the same as saying profits per share. So profits per share were 22.55 cents. And we know that the dividend was 19 cents. Now, what this tells you that almost all of the profit, if it made 22.5 cents, here we can see it's 22.6. If all of the profit, this line right here, was paid out in dividends, this line right here, what that means is that the company is returning most of its profit to its shareholders. So that means it's not leaving that much in the bank, as I think Plant One pointed out earlier on, as retained earnings. So the difference between this figure here, the 22.6 cents of profit, and this one right here, which is 19 cents of profit, is what we call retained earnings. So that's what the company keeps for itself for next year to fund growth and to do all those types of things, like the extra growth and put cash in the bank and all that sort of stuff. But we can see that the company's paying out a lot of its earnings as dividends. Now, that's not necessarily a bad thing. However, we want to make sure, we really want to make sure that the company has a stable history of profit, also known as net income, right here, and it has a stable history of dividends, which is this one down here, common stock primary issue, so DPS, which stands for dividends per share. So it's probably wrong of me to put them on the same chart because they're totally different numbers. First of all, let's look at net wealth over time. You can see that it's slowly but surely made more and more profit kind of year after year. This is a business that keeps kind of ticking over. It's growing profit. That's a good thing. And Chanda in the comments says, net wealth is a good, solid company with strong historical financials. Yeah, right. I would agree with you, Chanda. These are strong financials. Look at those. Look at that. That's kind of up and to the right. That's where we want it. Jonesy says, that explains why net wealth went up so much last week. Yeah, so we'll talk about that in just a second. So dividends per share. Now, if we check over here, we can see that net wealth started paying a dividend to its public shareholders in 2018, and its dividends have just kept on creeping up. Paying attention to the axes over here, the dividends have just been creeping upwards over time. Now, not all companies are like this. And just because it had a dividend in the past does not mean it has a dividend in the future. Once again, that's why I'm telling you to look at the growth rates to make sure this business is growing. Because if the business is growing and the management want to pay a dividend, then you have a reasonably good guess that it might pay a dividend in the future. It's not guaranteed. Dividends, as we talked about last week in the passive income episode, passive income is not guaranteed. So you might remember this from last week, guys, where we talked about the different companies that you could put into a portfolio to make it to make income from your portfolio. We said dividends are not guaranteed. Keep that in mind. But net wealth has done a very good job. So there are a couple of questions here. How long can a company pay frankings when the share is dropping consistently? This is from Manish. I have Appen shares and it has dropped significantly. Yeah, so Appen is a company that I used to own in my personal portfolio. And what we can see here is Appen's revenue has continued to increase, which is great. But if we come down, we look at dividends, we can see that dividends have kind of plateaued a bit. We can get rid of that one. We can look at the net profit or net income. Net income is just how they say it in the US, guys. So here in Australia, we say net profit, they say net income. So it's the same thing. So here we can see that the profit of Appen has continued to go up. But if we look at the shares, where is my chart? Just need to zoom out a bit. So we can see here. We can see in the last 5 years, this is what Appen has done. And Manish, I feel for you because you can see Appen up the top here looked like it was, really growing strongly, and then this has happened. And the reason that Appen has fallen, for those of you who don't know, Appen is a machine learning data business. So they basically have algorithms and 1 million people, freelancers around the world, who provide feedback on algorithms. So basically, you get told, hey, do this search in Google and tell us what you see. And then you report that back to Appen. And then Appen sends that feedback back to the Google engineers who will then write better algorithms for next time. And it's basically a business involved in making machine learning and artificial intelligence better. And what's happened over the past few years is that many of the big companies like Facebook have kind of slowed their spending a bit in that regard. So that's why we've seen the shares come off a bit here. So people are a bit freaked out. I don't really have a view on when Apple will stop paying its dividend. So keep that in mind. I don't think anyone could tell you for certain, Manish, when they will stop paying a dividend. Okay, so the next point was from Zemesu, who says, regardless of the shares held at X dividend date, you still have to hold at least one share on record date to get the dividend. Yeah. So you want to hold the shares on the record date. That's correct. So you want to if you're a long-term holder, just hold it through the period. X dividend date is the date that the shares no longer have a dividend held in them. So for example, what I mean by that is, let me just bring this up. So sometimes what you'll see is that if a share price is here, and then the next day you wake up and all of a sudden it's 3% lower, the first thing that you should look at is when the dividend was paid, because that's probably the X dividend date, meaning it's excluding the dividend. So that's to basically say that whoever held it yesterday is going to get the dividend. For everyone from here on doesn't. So keep that in mind. People get really confused with dividend dates. There's X dividend date, there's record date, and there's cum dividend date, which is the CUM date. All of these things are kind of confusing at first, but once you get the hang of it and you see your dividends rolling in, you'll get a feel for it. But for long-term investors, like I imagine many of us are, we just kind of hold through it and receive the dividends anyway. So let's go back to the screen. So net wealth, there was one quick comment in here. I'm going to get to the other two companies in just a moment, but there was a question in here about why did net wealth jump last week? And so I was a very happy shareholder of net wealth, I must admit, last week when the company made this announcement to the ASX. And basically they said, hey, look at all of the clients' funds. So see this section right here where they've got FUA. Remember, net wealth's business is basically we give financial advisors the tools to invest the money for their clients. And so the key measure to determine net wealth success is how much money is being administered on its platform. So that's what we call funds under administration. So this isn't net wealth's money. This is the client's money that is being managed on the platform that net wealth has created. And net wealth earns a very small fee. But if you come right down the bottom here, and I'm surprised they buried this right down the bottom, but the reason that net wealth shares jumped 14% in a day is because of this very last line here. And basically, let's zoom in again. Management came out and said, due to the record amount of new client money on the platform, that's basically what this means, and the growth of our already substantial new business pipeline, we're upgrading our FUA net inflow guidance for 2022 from $10 billion to 12.5. So basically what they've said is, we're growing faster than what anyone else expects and what we expected. So that's why shares jumped. If we look at the chart from the last month, we should be able to see it. That's why net wealth shares jumped substantially just here. So I was very happy about that. If I do say so myself, humble brag there. Dark Dragon asks, if you are in a dividend reinvestment plan, what happens to your franking credits? That's a really good question. I believe that they're just held in the company. I don't think that you benefit from them. I don't actually know the answer to that question off the top of my head. I've looked it up before. If someone else wants to talk about it in the chat, otherwise I'll follow up. I'll include some notifications here because I can't remember off the top of my head. I think you still record the franking credits, but there might be a tax agent in our chat, so hopefully there is, and they can fill you in there, Dark Dragon. Okay, so Shamila asks, how does net wealth compare to Magellan Financial Group, MFG, and Platinum Asset Management? I'm so thrilled that you asked this. Shamila, it's like you're a psychic or something, because I had actually planned to talk about Magellan next. It was on my list just over the corner here. So Magellan is another company. So let's go through the process of looking at Magellan's financials and seeing how Magellan stacks up from that kind of dividend security perspective. So let's first of all, let's just go here into the financial section and let's see. So is revenue growing? This is revenue, like sales, if you think about it that way. So Magellan has recorded very strong growth over a very long period of time. Things have started to plateau recently. So what does Magellan do? That's probably where I should start. Magellan is a fund manager. So if, for example, let's say that I'm an investor, and let's say you say, hey, Owen, I'm sick of this investing stuff. Can you just manage my money for me? And I'd say, yes, sure, I can do that. However, I'm going to charge you 1% per year. And you say, sure, no worries, here's my money. And then I go and invest that for you. It's still your money. I just invest it for you and I earn 1%. So what we do is then we take your money, we invest it, we get returns. And if you're happy, you stay with us. And that is basically what Magellan does. Magellan invests money for investors. So it's led by Hamish Douglas. Yeah, be great. Gilly Muster says, great question, Dark Dragon. Be great if Owen can post his response. Yeah, I'll follow up, definitely, Gilly Muster, because I definitely looked it up. I just don't want to say the wrong thing on a live chat. So I'll make sure I have all my I's dotted and my T's crossed before I go and blurt out something. So the other thing we want to look at down the bottom here is net income. So this is profit, basically. Remember, this is profit. So we can see here that Magellan's profit has dipped slightly. So Magellan makes profit principally in two ways. The first, as I said in my little example, which is actually very relevant, is that it earns basically a 1% fee every year from its investors. It's a little bit less than that depending on which way you want to invest with them, but we'll use 1%. And they also make performance fees. So going back to my example, if, for example, you say to me, hey, Owen, here's all my money that I want you to invest for me, and you can take your 1%, but also I want you to do really well. So if you do really well, I'll give you a performance bonus. And that's what Magellan earns. Magellan earns a bonus in the shape of performance fees, and the performance fees just haven't been there for the past year. So if we come in here, we can see Magellan's FY21 results. We can see the funds that they manage are $103 billion. It's up 9%. The management fees, that's that 1% that I was talking about, rose to $635 million. I remember interviewing Hamish Douglas, the founder of, or co-founder of Magellan many years ago. And I don't think, maybe he thought that it was going to be this big, but I feel like he wouldn't have. And I also interviewed him again a few years later. And I've got to say, I feel like still, it just keeps amazing me how big this company has grown. So profit before tax of $526 million, it was up 10%. We can see here statutory net profit was down 33%. And we can see down the bottom here, there was a total dividend for the year, which was down 2%. And it was only 75% franked. So it wasn't fully franked. Now that's okay. It's still got some franking credits. So you'll still have some franking credits to your name when you do your tax return, but you won't have as much as if it was fully franked. And so this here, you can see here on the page, Magellan's management fees up the top. It's probably very small. Apologies. So we can see Magellan's management fees at the top here, and we can see the performance fees right below it. So we can see that in 2020, Magellan made $81 million of performance fees, but in 2021, it only made $30 million. Now that's a big difference. That's $50 million difference in performance fees. And that's simply because the performance wasn't good enough to earn performance fees. That's basically the way it works. So you can see here that Magellan's profitability wasn't as strong. So if we come down, remember how I said to look at the earnings per share or profits per share, EPS, we can see here that by the time you get down here, you can see the impact that it has reducing profit on those shares. So the earnings per share, maybe we'll use the adjusted ones, we'll take management's word for it and use the adjusted ones. We can see here that it earned 225 cents per share of profit. And the interim and final dividend was 199 cents per share. So what this basically shows you is that, well, actually, sorry, what is this here? Total dividend per share. I didn't see this before. Annual performance fee dividend. Oh, they've separated out the performance fee dividend. Never mind about that. So we can see total dividend. We'll just use total dividend here of 211 cents. So basically we're comparing adjusted profit per share, 225 to 211 cents paid out as dividends. So what we can do here is if we take 211 and we divide it by 225, what that is showing us is that 93% of the profit is paid out in dividends. So that would mean, and this comes back to an interesting point before from, I can't remember who asked this about Appen, but basically what it means is that if the profit keeps falling, the dividend will have to be cut, or at least most likely be cut, because you've got to remember, if it's not making a profit and it doesn't have enough cash in the bank, it won't pay a rising dividend stream. So here we can see Magellan's dividend policy is to pay out interim and final dividends on 90 to 95% of the profit from funds management. And the annual performance fee, so if it earns a performance fee, it's going to pay out 90 to 95% of that. So this is a really interesting thing. So they've come out and said, this is their dividend policy. We're going to pay out 90 to 95% of the funds that we earn, the profit that we earn as dividends. So not all of it. So they're going to keep some in the bank, obviously that 5 to 10%, so they can fund things in the future, going to keep that cash for themselves. You can see here that they're also implementing a dividend reinvestment plan. Pardon me. So what is a dividend reinvestment plan, or DRP? We've talked about this. Imagine if you want to, instead of receiving cash for your dividend, you receive more shares in Magellan. For you, that's probably good because you can compound and you get more shares over time. And if you believe in Magellan's long-term growth, you're going to benefit. But also, what it means for Magellan is they don't have to pay you the cash. They can just give you more shares and keep the cash in the bank for themselves. And so that's why they benefit from it. So we've had some great responses in here. Leo K says, from my memory, if you participate in a DRP, the new purchase is equal to the franked amount. The franking credit will be refunded at the tax return and will be taxed the same. You just have to wait, you just have the shares instead of cash. Yeah, and so this is what I imagine. I imagine you'd still be taxed on the equivalent amount. So let's say, for example, you had a dividend of $100. I'm pretty sure you're still taxed on the same amount, and you still have the franking credit stored under your name. So I think that's the way it works. So John T says, reinvestment plans have no effect on how much franking credits are treated in your or how franking credits are treated in your tax return. You still have them to credit against your tax. You will owe the dividend you received. You will own the dividend you received. And then Michael says, you will generally include the dividend and associated franking credits in your income tax return. The dividend reinvestment plan just means that instead of getting the dividend in cash, you'll get the shares. Yeah, so there you go. Wonderful help. Thank you to the SelfWealth community who have chimed in here. I think it's awesome. Dazza says, hi Owen, how does AEF compare to the above funds, Magellan and NetWealth? Yeah, so there was a question about what's the difference between NetWealth and the others. So NetWealth isn't a fund manager. They are a platform that financial advisors use. Whereas Magellan is a fund manager, they invest the money. So NetWealth doesn't earn performance fees. It's more of a software company than a finance company. Whereas Magellan is a proper finance company that invests money and earns a percentage. Australian Ethical is almost exactly the same as Magellan in that it earns performance fees and it earns management fees. But Australian Ethical also invests super on behalf of its members. So for those who don't know, this is another great company that you probably want to put on your watch list as well. Okay, so there was one, we've got one more question here from Dark Dragon. If you have shares in Magellan Financial Group, it's different to giving your money to Magellan Financial Group for that 1% cost, right? Because you're still owning the company as a share. Gosh, hope that question makes sense. Absolutely, Dark Dragon, it makes sense. It absolutely makes sense. So let's say, for example, if you're an investor in Magellan, so you want them to invest your money for you, you invest in their managed funds or their ETFs. And that's when you pay a fee. But if you just buy shares, like right here in your SelfWealth, you just click buy, you don't pay the 1% fee to Magellan. You just own the shares. So you're just a business owner. Yeah, so Iris Jones, it's like NetWealth in a way, but Iris tends to, I believe Iris does it for financial planners as well, but they also do like data and that sort of stuff. Yep, so Vince says you can still claim the franking credits even when you participate in DRP. Yep, absolutely. So thank you everyone that helped me out there. So Fortescue Metals Group, one final company. I know we're running a bit over time, but a lot of people wanted me to talk about Fortescue. And Fortescue, like Appen, unfortunately has had one of those horror kind of few months. Shareholders who own Fortescue Metals Group here on the right can see that shares have fallen off a bit from a high of around $25.78 to their current price of $14. So nearly halved in the last few months. So obviously, one of the things that I want to just remind everyone is that sometimes you'll come into your SelfWealth account and you'll see, Iris is also a software provider like Xplan, exactly, Leo. So there's Iris, there's heaps, there's Hub, NetWealth Premium, heaps of these platforms and software providers that work around financial planners. There's Class, there's heaps of different software providers for financial advisors. You'll often see Iris dotted around the place because they provide their data to like media companies and that sort of stuff as well. So anyway, I've got to wrap up soon, but I'll just be quick on Fortescue. Sometimes you'll come into your SelfWealth account and you'll see that the dividend yield is off the charts. You're thinking, wow, this dividend is huge, 24%. But remember, guys, it's all about, can the company grow its profits into the future? Fortescue Metals Group sells 92 or 93% of its products, being iron ore, to Chinese iron ore and steel making companies. The other percentage of it comes from railway and basically it earning rent on railway. So Fortescue is one of those great Australian success stories when it comes to mining. But in terms of other things, it's probably not as stable as those other businesses that we talked about. So here we can see revenue is going up because iron ore prices have gone up in the last year. But if we come down, what we will see in net income is we'll see it pretty bumpy, net income, and then again, income has soared, net income or profit has soared as iron ore prices have stayed up. And then if we come down, we look at dividends, we can see dividends have soared. But remember, guys, this is only in the past 2 years. I want to emphasize that point. So what you have to determine with your analyst caps on or with your investor caps on is, can the dividend be sustained? And all the steps that we've followed are the most important steps to follow. So for example, that would be looking at the annual report. Is revenue growing? Can it still continue to grow? Can profits continue to grow? Not just for 1 year, but for many years into the future. As much as I have so much respect for everyone at Fortescue, what I find pretty concerning is that so much of its income is tied to iron ore prices. You can see here that revenue basically jumped, not quite 100%, but it jumped a lot year over year. The cost to produce the iron ore didn't really increase, but the gross profit did. And that's why, because revenue increased so fast and sales didn't increase that fast, you have this huge change in gross profit or profitability overall. And that's what enabled it to pay a dividend, pay down debt, and so on and so forth. One final thing when you're looking at dividend companies is look at the balance sheet. Make sure the company has plenty of cash and not as much debt or borrowings, which are these lines here, because if it's in a strong cash position, that obviously gives it flexibility for the future. So keep that in mind. Paul Hurst says, this on the ASX side, the ex-dividend date occurs 1 business day before the company's record date. To be entitled to a dividend, a shareholder must have purchased the shares before the ex-dividend date. Exactly, because the ex-dividend date is the date that is excluded. So Paul, maybe Paul, you can put a link into the ASX commentary on that. That would be wonderful, because then you can direct everyone to that. So Chanda S says, thanks for another great episode. Claire says, and then thanks to Rob. It's Rob. Yes, that's right. So thank you, Claire, for coming along. But Forrest has big green plans for Fortescue. Am I right? Dark Dragon, yes, you are right. Fortescue has more to it than iron ore now. It is looking into hydrogen. Andrew Twiggy Forrest, who is the founder of Fortescue, has done some tremendous lectures on the future of hydrogen energy. If you're interested, you can go and check that out. Fortescue has effectively established a business within a business to try and make green steel and green iron ore and push that upon the rest of the industry to turn operations like this here that you see in the image green, to make it carbon neutral or carbon positive. So that's a long way off. And here's basically most of his speech, but you can see that and get that on the ABC website. So we've talked about a lot today. Thank you, everyone. I'm really impressed with everyone actually who filled me in on the dividend reinvestment plan. It was a great exercise there, getting some feedback from you. I just couldn't remember exactly. There are some other rules around, I guess, how certain dividend reinvestment plans are. There are some special dividend reinvestment plans in Australia, which we can go into next time. But thank you, everyone. And it was great to see Andrew Ward in the chat. Special shout out to Andrew Ward, founder of SelfWealth. Always a pleasure to have you with us, Andrew. Thanks to Rob, who joined me. And thank you to everyone who joined me today. In the coming weeks, we're going to talk about share investing for kids. It's a new feature that people can use SelfWealth for. Basically, we all want to invest for our kids. So how do we do that? If you are interested in getting that passive income spreadsheet from last week, go into last week's episode and jump into the comments section there, the live stream comments, and you'll see a link. And then you can put all your companies in and follow the steps in there. Just remember, franking credits are great for investors. You still have to pay tax and you still have to do all that, but they can help you offset some of that. So yeah, there's plenty to go on, guys. Don't forget to hit that subscribe button so then it notifies you when we go live next week. But we'll be back here at 12 midday next week to talk about all different types of investing. If you have any questions, you can send them to us. Just drop them in the chat there. We'd love to hear from you. And if you need any help with your account, head to selfwealth.com.au, hit that support button. Thank you, everyone, once again for joining me. It's always a pleasure. So thank you so much.